Okay, so this is problem 4.1a of adjusting entries. It says Florida Palms Country Club adjusts its accounts monthly. So we will be doing monthly adjustment and we'll assume that till November, uh, all of the adjustments are already made and we just have to do the adjustment for the month of December. Club members pay their annual dues in advance by January 4th. The entire amount is initially recorded to unearned membership dues. Now, why is it initially recorded to unearned membership dues? Because if you are receiving money in advance from your customers, then that is not an earned income for you. Until and unless these members do not use that club for 1 month for the remaining year, it is not your earned income. So currently, it's a liability for you. This unearned membership dues is a liability account. At the end of each month, an appropriate portion of this amount is credited to membership dues. This is your revenue account. As members utilize the services each month, you transfer the amount from the unearned membership dues to this membership dues account. So you transfer your liability into your revenue. Guests of the country of the club normally pay green fees before being allowed on the course. So there is another expense that the members have to pay, which is green fees. The amount collected are credited to green fee revenue at the time of receipt. Certain guests, however, are billed for green fees at the end of the month. The following information is available as a source of preparing adjusting entries. Salaries earned by golf course employees that had not yet been recorded or paid amount to 9,600. Now, the first transaction says salaries earned by golf course employees. So, earned means that the golf course employees have already provided the service. So, they have earned the income. That means that it has already become an expense for you. However, you have still not recorded or paid the amount. So it's fine. Even if you have not recorded it, or even if you have not paid the amount, it is an expense for you since the golf course employees have already earned this income. They have already provided you with the service. So when we record something as an expense, we're going to record it as debit. Okay, all of the entries are going to be for the month end, so 31st December, and salaries expense debit, and we have not paid for these salaries. So salaries payable will be credit. And we're going to write a small narration for this amount. Second is the Tampa University golf team used Florida Palms for a tournament played on December 30th of the current year. So there's a university that have actually used the club on December 30th. At December 31st, the 1800 owed by the team for green fees has not yet been recorded or billed. So the golf team has used the club. Because they have used the club, this is an income for you, regardless that they have paid or not paid. So they have actually not paid the green fees amount to you. However, they have already played the tournament on your club. So because they have already played it, it is an income for you. So you can straight away book it as your income, green fees revenue. And because it's an income, you're going to record it as credit. Now they have not yet paid it to you, so you cannot debit your cash amount. So what should you debit? The amount that you should debit has to be your account receivable then. If they have not paid it to you till now, they will pay the amount to you in the future. So account receivable will be debited over here. Because even if they're not paying it to you right now, they're going to pay it to you in the future. Then third is membership dues earned in December for collections received in January amount to 106,000. Now, membership dues it earned in December. Remember, you have collected the membership dues on January 4th. January 4th, and now it is December. It is the last month of the year. And it is telling to you that the membership dues that you have earned in December for collections received in January, all of the collections were received in January. So this is the amount of money, 106,000, that you have now actually earned. This was initially recorded in January as your unearned membership dues. Remember, they said that whatever you're going to collect on January 4th is going to go into unearned membership dues, which was a liability. Now in December, you have earned this income, which means it's no longer a liability. You have actually provided the service to these members. So if you have earned the amount, we know for sure that we can record it as our membership dues earned. So there should be an earned over here as well. And this is the amount. We're going to credit it because we have earned this income. And we also know that we had already recorded this amount in our unearned membership dues as a liability, and it is no longer a liability for us because we have earned this amount. So we're going to decrease our liability. Over here, we're decreasing our liability, therefore debit. Now, fourth is depreciation of the country club's golf carts is based on an estimated life of 15 years. The cart had originally been purchased for 180,000. The straight line method is used. The clubhouse building was constructed in 1925 and is fully depreciated. So we do not have to depreciate the clubhouse building. The only thing that we need to depreciate are the golf carts, and they have given you the historical cost 180,000. So the formula for this was the historical cost, which is 180,000. We're going to take that and we're going to divide it by the monthly depreciation. So 15 years multiplied by 12. 1 year's depreciation is coming out to be, 1 month's depreciation is coming out to be 1,000. We need to record this. And it's the same thing. So we have used the golf cart. So it means it is now an expense because you have utilized something. And it is called your depreciation expense when you use up a non-current asset. So we have recorded that 1,000. And we are not going to credit the golf cart account directly because we want to keep the historical 180,000 separate. So in order to credit something, we want to reduce golf cart, but we're not going to use the account of golf cart. We're going to use a contra account for it, which is called accumulated depreciation. This is specifically for your golf cart, and you're going to credit this amount. So it does the same thing as reducing the asset, but not actually doing it in the actual asset account. Okay. Then we have fifth. So 12-month bank loan in the amount of 45,000 had been obtained by the country club on November 1st. Interest is compounded at an annual rate of 8%. The entire $45,000 plus all of the interest accrued over the 12-month life of the loan is due in full on October 31st of the upcoming year. So we're not going to make any loan installment payment, neither are we going to pay any interest. They're saying that the loan and the interest will be paid 1 year later on October 31st. The necessary adjusting entry was made on November 30th to record the first month of accrued interest expense. However, no adjustment has been made to record interest expense accrued in December. Now, for loans, you need to understand this, that when you take out a loan, you will have to pay interest on it. And you will have to pay the principal amount back as well. So $45,000 is the principal amount that you have to return. And on this $45,000, you will have to pay an amount of 8% as well. So let's just calculate this. 45,000 times 8%. So 3,600 is the amount of interest that you will have to pay on this loan. So 3,600 is the amount of interest. Now you have to return the $45,000, and this 3,600 interest is going to be charged on that 1 year that you have the loan. So this interest that you have to pay extra is an expense. The $45,000 is a liability. We do not do adjusting entries for asset liabilities and equity. We make adjusting entries for only revenue and expenses. So we just have to record this 3,600 expense, which is the annual. And we are doing monthly adjustments. The November one has already been recorded. So if I convert this into months, that means divided by 12. 300 is a monthly adjustment for the interest expense that I have to make. So the moment you take out the loan, interest is being charged on it. So the 1 month that the loan is with you, you have to record the interest expense, even though you're not going to pay for it. You have to pay it 1 year later, but still you need to record the interest expense because you are using that loan. So interest expense will be debit because you're using that loan and you're not paying the interest amount. So a liability will be created, interest payable, to record the fact that you are not paying it. Sixth is a 1 year property insurance policy has been purchased on March 1st. The entire premium of 7,800 was initially recorded as unexpired insurance. So a 1 year property insurance policy had been purchased on March 1st. On March 1st, when you purchase this policy, it's for 1 year. On that date, you must have recorded it as an asset. So this unexpired insurance is actually an asset account because you're not going to use it on March 1st. On March 1st, you have purchased it, and now for 1 year, you're going to use it after March 1st. So unexpired insurance was an asset. Now what is happening? You have used it up for 1 month and you need to record this as an expense. So an asset has to be converted into an expense over here. So insurance expense debit and prepaid insurance policy credit because you are reducing your asset. We should actually use the name that they have used. So you're going to credit your unexpired insurance, which is an asset account that has decreased. And we're using 650 because again, we need to do the adjustments on a monthly basis only. So we're going to divide it by 12. In December, Florida Palms Country Club entered into an agreement to host the annual tournament of Florida Seniors Golf Association. The country club expects to generate green fees of 4,500 from this event. Now, what should we do over here? It's just an agreement. That's it. Nothing has happened. Neither it's a revenue, nor is it an expense, nor is it an asset liability equity. It's nothing. It's just a contract that is going to be signed in the future. So we're going to make no entry for this. We have to make no entry over here. Eighth is unrecorded income tax expense accrued in December amounts to 19,000. This amount will not be paid until January 15th. So it's an income tax expense and it's accrued. Accrued means that it has already been incurred, but you have not yet paid for it. Because it's an expense that has already been incurred, we're going to debit the expense account and we have not paid it. So we're going to create a liability for it since we're going to pay for it in the future. And we are done with this question as well. And so we have all of the narrations written over here as well. I forgot to actually show you the narration. The narrations are just a brief statement. You can just write any short statement that actually tells you what is happening in that transaction.